What is up, YouTube, and welcome back to yet another Fridge Financials video. And in today's video, more of an informational one, just an article to always bring forth some education, is this article struck me by surprise. Gamblers are dumping stocks to bet on sports, a new study says. So we're going to analyze the article, talk about it, give you my input and my feedback. We'll go from there. So if you're excited for today's video, as per usual, feel free to like the video. Subscribe to the channel. We're very close to 200 at the time of recording this, and turn the bell notifications for all future uploads. And I will zoom in on this a little bit because I feel like you gotta be able to read a little bit more here. So the article was originally posted by Bloomberg, but I don't have a Bloomberg account, so I can't read it. So this website also posted it, which is really nice. So as sports gambling takes off in the US, turning quickly into a multi-billion, with a B, dollar business, a worrisome trend is starting to emerge. Americans appear to be yanking money out of their stock brokerage accounts to fund their online betting. And just by hearing that sentence already also has me worried as well. This is the key finding laid out in a recent working paper titled Gambling Away Stability: Sports Betting's Impact on Vulnerable Households. It claims to find evidence that for every dollar spent on the recreational activity, gambling, now legalized in most states since 2018, net investments in stocks and other financial instruments dropped by just over $2. So for every dollar someone spends on gambling, the net investments in stocks and other financial instruments drops by just over $2. I know it doesn't seem like a lot, but again, think about millions of dollars. You know how much money is gambled every single day? Hundreds, thousands, millions of dollars every single day. That's not, I don't like to hear that. You're depreciating your assets and your net investments to increase how you gamble or to pay for gambling. Not a good start here, this article. The phenomenon is most acute among the most financially strained households, potentially the same ones trying to get rich quick schemes in financial markets like meme stocks and speculative options. What this is really saying is this is mostly happening in financially strained households, or households that have a hard time with having money and getting access to money. It's just like a lot of people that play the lottery. A lot of people that play the lottery, my family included, a lot of my family plays the lottery and stuff like that, but it's because they're financially strained. They're trying to get rich quick, trying to make money, make millions, make thousands, make anything. So trying to get rich quick, not wait long term, want to get a lot of money, they want it fast, they want it now. So where do you get it from? Gambling. And meme stocks and speculative options, which we'll talk about that a little bit later on, of course. So these are get rich quick schemes. And usually, if a lot of us already know, get rich quick hardly ever happens. It's only that 1%, 0.1%, there's probably data behind it as well, of people that are getting rich quick. Winning the lottery, hitting it big on options and trading, hitting it big on meme stocks, but that's a very, very small percentage. A vast majority of us are not getting rich quick. We're getting broke quick, or we're going broke quick because we're spending money on this kind of stuff here, right? There's a real cost, particularly to constrained households here, that I think should concern policymakers. Casino defenders see it differently, saying that the study, which has yet to be vetted by academic peers, so I guess that means that it's not essentially like a valid, like it has to be valid. It doesn't have the validity yet from peers of this study here, draws false comparisons between investing and gambling, with the latter more apt to compete for entertainment dollars. Whatever the case, thrill-chasing retail pursuits from sports wagering to financial trading are booming in the post-pandemic era, and gamified platforms of all stripes stand accused of engagement bait by giving Americans a dopamine high in a bid to ramp up online action. So, essentially, and they're going to quote about it a little bit later on, for example, Robinhood has been one that's always been speculated as someone who's trying to get people to gamble money. You have confetti when you buy stocks at times. I don't know if they took that out yet. I think they might have taken that out. You get prizes for referrals. You get all these different things that basically gamifies investing. And again, gamify makes it sound like you're looking into a game, an entertainment aspect. And people are looking at it like, oh, I want to make money. And that's what they're thinking about doing. And it starts to create this dopamine, as they say, of wanting to make a lot of money and trying to do it quick. So Robinhood's been really, really well known for doing it in this way and not making it like a boring investment page. Like if you look at like Schwab or Fidelity and even Webull and compare it to Robinhood, you'll see the difference as to how Robinhood looks more gamified compared to the other brokerage accounts and the investment accounts. So that's essentially what they're really talking about here. But again, post-pandemic era, there was a huge move forward. Post-pandemic era was the meme stocks of GameStop and AMC, where people made a crap ton of money buying up the shares of that one. You have people that were at home trying to make money because they were laid off, so they had to think about how to make money, gambling, investing, trading stocks, trying to make it big, those kind of things. So there's been a huge rise in these kind of activities. Framed this way, sports wagering and equity speculation can be seen as two sides of the same coin. As such, speculative stock trading could even be saving a cohort of gambling adult Americans from a worse fate. So essentially, if you're investing in speculative stocks, like, not major companies, the ones that might become the next Amazon, Facebook, Google, whatever, they're saying that, even though it's a risk you're taking, it's not as risky as gambling. And it saves you from gambling because of that reason. So that's what they're really talking about here. Blowing away their money on online sports wagers, money that instead can be deployed in their stock trading accounts. Okay, so again, it's interesting to think about how now we're comparing, investing to gambling. Usually think of investments as this idea of trying to grow your wealth, trying to make money, trying to become financially free, trying to retire. And gambling is like just for fun. You're going to lose money. Don't even think about trying to make money on it and everything else. And now we're trying to compare the two. Regardless of your view on the interplay between gambling-like activities, it's increasingly the subject of research. Robinhood Markets, very well known for it, meanwhile, is taking steps to nudge the retail crowd away from casino-like wagers on the likes of GameStop and into sensible index trading investments. So they're taking a step back. They're like, we had a lot of people who were in the meme stock craze, who were into GameStop, AMC, all these meme stocks, and people were starting to look at, Robinhood as a gambling kind of thing, and because it's gamified, looking at it as gambling money away, not investing here. So they've taken some approaches to make it seem like it's less of a gambling investment brokerage account and trying to get people away from those kind of bets and trading and everything else. While trading stocks with shaky finances often draws a parallel to gambling, whether the broad stock investing can be treated as the same category is debatable. To David Foreman, Vice President of Research at American Gaming Association, the paper exaggerated the effect of gambling on households' financial health, and more importantly, its premise was flawed. So that's him looking at the article and his input. They talk about spending on sports betting as a negative expected value investment compared to other positive expected value investments. Basically, when you sports bet, you're going to lose money. Net negative, you're negative. You're losing money and everything else. Whereas other things, you're making money and everything else. That's just not how consumers think about spending their entertainment dollars in sports. It is not an investment, it's an entertainment option. But it makes sense to compare gambling to stock investing in that both involve risk-taking and financial reward. And that is definitely true. You could put $1,000 into a company and the company could go bankrupt tomorrow. And you're just out $1,000, blink of an eye, out $1,000, that's it. So that's like the argument. Just like if you put $1,000 on, so-and-so to win, this game, so-and-so to score a goal, whatever it is. Doesn't happen, you're out the money, you don't get it back, it's done, it's over with. Similar, 100%. The difference for me that I look at it is, if you're investing in high-quality stocks or ETFs, like most of my money is invested in ETFs, which is basically a basket of stocks. So all these stocks have to go to zero in order for me to go to zero also and lose all my money. Also, here's the thing to keep a note of, right? When you're investing money, you are somebody who the money can always come back. And let me tell you about that as an example, right? Take a look. So I invest in the SPY. SPY just tracks the S&P 500, all their accounts and everything else. Take a look at the daily market here. Now, as you might have seen in the news, the market lost a decent amount of money here. So as you will see here, we went from $565 a share all the way down to $510. You lost $55 a share of this company right here. With sports betting, saying I'm going to bet it to go up and it goes down, boom, your money's out. Your money's gone. You don't get it back with sports betting. You get rewards, but it's 10 cents for $100. Oh, wow, cool. but you don't get your money back if it loses. Obviously, if it wins, great, congratulations, you doubled your money, you made some money, whatever the case is. But the risk, the downside risk is a lot higher than stocks and investing. Again, in quality companies. If you're investing in GameStop, then I don't know what to tell you. That's literally gambling your money away, because GameStop, you look at their financials, you look at everything else, not as good, right? But think about this, right? Imagine you bought up here at 565. It goes down to 510. You're down $55 a share. But as long as you don't sell it, we're back trading at 556. So from here to here, instead of being down $55 a share, you're down $9 a share now. So you've made a lot of that money back. The minute this market starts to go up higher again and get closer and closer to like 600 or whatever, you're in the positive, making money day by day. If it increases, great. If it decreases, that does happen obviously as well. But the difference is that it's not, you have a chance of the money coming back. Gambling, you don't. Gambling, you win it, great. Woo, you're up here. Gambling, you lose it, wow, we're down here. That's it. There's two sides of a coin. Stock markets are not as similar in that aspect. So that's why I say, instead of gambling, if you're gambling money, gamble money you are okay with losing. Because more than likely, like a lot of us, because I did sports betting for a little while, more than likely you're going to lose the money more than make money. So gamble money you're okay with losing. Don't gamble money that you don't want to lose. If you don't want to lose money, you can look at investing into the stock market and everything else if you still want to have your money make more money. And again, S&P 500 is the best example, because you just make money and make money and make money and make money. Lowest at this point, this was back in about 2 years ago, 339. It's now up over $220. $220 per share, just like that. Almost, looking at pretty, like 75% maybe or something like that return, just like that, just by having your money invested. Retail traders, retail again is just myself, you, if you're watching this video, have been flocking to options trading. Options trading is essentially gambling to an extent, obviously, making up 18.8% of the total market activity compiled from JP Morgan Chase. So essentially what options trading is that you're basically trading stocks, but it's with leverage. For example, options trade in batches of 100 shares. So you're buying contracts of 100 shares of a company. So you're basically giving yourself access to 100 shares of a company, because 100 shares of SPY is $55,000. Or you can, buy an option. These options, you can look at whatever it is. As an example, this is what options are like. I know it's a lot of numbers to look at here. But you can look at options, and you can look essentially at owning 100 shares of SPY. And they have, again, what's called a strike price, which basically means that that's what you want it to get to. So say I think that SPY is going to be at 560 in 2 years. I might bet that I might open up this option as a result. It's a contract. And say, you know what? I have 100 shares of SPY. I think it's going to go up to 560. The thing is, though, is that you're paying what's called a premium in order to have owned this stock and own this contract, I should say. The difference is that essentially you're paying $74 per share for this contract, or whatever the minimum is, $75. Right here, that's the minimum. That's like the last I went for. And the reason why I'm saying, well, fridge, does that make sense? Well, think about this, right? Instead of buying 100 shares of SPY at $55,000, because that's what it'll cost, you could own 100 shares for $75 each, which becomes $7,500. So you have access to 100 shares worth of SPY for $7,500. The risk is that, again, the strike price is what matters. If SPY doesn't go to 560 in 2 years, you're out the $7,500. It's a gamble. It's a bet. You're risking $7,500 to make whatever the case is. It's a bet that can be risky. And that's what people are doing, but they're doing it with meme stocks like GameStop, like AMC, like all those other ones there, not valid companies. And that's essentially what happened in the post-pandemic era. When everything closed down, people were betting heavily and doing options trading. options trading is very complicated to an extent, so I don't want to explain the whole thing, but basically you're just getting more shares for less price, but there's more risk. Okay. Regulators have expressed concerns that brokerages are gamifying stock trading in a way that lures people into putting more money at risk. Robinhood, again, is the most common one. They had granting free shares on friend referrals, drew an army of first-time investors in the pandemic when Americans were stuck at home and handed stimulus checks. So that's like the crazy aspect thing about it. Now, this article talks about more and more about, what you can do and everything else like that. I just think that this in itself, saying that people are selling their investments and selling their stocks to then go gamble, just doesn't make sense. I'm not a financial advisor, and I'm not going to say, hey, do this and do this. To me, it doesn't make sense. If you want to make money long-term, investment account, buying the S&P 500, you make money. You make money. See? You can look at the daily chart, you can look at the weekly chart, you can look at the monthly chart, you can look at the long, look at that. Oof. Only goes up. This ETF tracks the top 500 companies in the world, or in America. So if all those go down, like Walmart, like Amazon, Facebook, we're in an apocalypse. So very unlikely, but as you can see, here's a trend here. So the stocks are going up and up and up and up and up, making a lot of money, Great. My only thinking is that if you want to be part of the gambling aspect, A, pick money that you are okay with losing. If you're putting your rent money on the line in gambling, that's just going to be a bad idea. Don't do that. A. B, you could invest, if you really wanted to, in gambling companies. Like if you wanted to, you could invest in DraftKings. Big one. You can invest in DraftKings. I think that's the only one that's actually another one. Penn is one that I have a little bit of exposure to. You can do Penn Entertainment if you want to, where you can make some money if you want to think about their being big long term. So there's ways to basically have investments in gambling. It's a multi-billion-dollar industry, but without actually gambling money and everything else. Not financial advice, of course, as per usual. Very interesting article. Something that's very, very, something to really take seriously and to really understand is that please don't sell for gambling. Gamble money you're okay with losing. Don't put your retirement into gambling. It's easy. You set it, you forget it. Buy into this index fund, set it, forget it. It goes up, great. If not, then, buy more, whatever the case is. But that's what my advice is. Obviously, it's not financial advice, of course. So please actually talk to an actual advisor, do some research, do whatever it is you got to do. Do not say, well, Fitch Financials told me that, because I am just an average person just like you guys are. I'm not someone crazy. I'm not some guru or anything else. So thank you so much for watching today's video. Again, just a very insightful article about how people are putting more money into gambling. I don't like that. I want you guys to be thinking about, go long term. Don't try to get rich quick. It's not a thing. It's very hard to happen. Go long term. Build your retirements up. Build your investments up. Build your financial freedom up. So I hope you guys are making money as the market as per usual. And again, feel free to subscribe to the channel. And I will see you guys as per usual in the next video.